Welcome to the Executive Compensation Podcast. I'm your host, Ryan Harvey, and on this episode, I'm joined by Dan Kaufman. Dan is a partner working out of Atlanta. Dan, welcome to the podcast.
Thanks, Ryan. Happy to be here today.
So, stock-based incentive arrangements are by far the single largest investment that most compensation committees oversee. The accounting expense and dilutive expense of equity incentives make up a significant portion of executive compensation mix. So, how should companies manage this investment? What's the best way to measure the cost of equity programs? And what do investors and proxy advisors have to say about these costs? On today's podcast, we're going to explore these issues further. So Dan, maybe we can just start out with you just answering a very kind of basic big question, which is why are compensation committees, looking at equity usage? What is the kind of the big governance issue that they should be focused on here?
Yeah, no, Ryan, I think that's a great question and a good starting point. And I think you hit on at least one of the key points just even in your introduction. Compensation expense from an equity base tends to be the most expensive aspect of compensation. And especially at the most senior levels in the organization, within their compensation program, equity makes up the biggest mix. So there is a significant amount of value and expense that goes into these programs. And as such, it becomes a very much a focal point for investors, for activists, for the board to look at to make sure you're managing the program correctly. It also is dilutive. By nature, equity, the more equity you grant, the less on a per share basis existing shareholders have in value. So the more that you grant, the more dilutive is, which is part of the oversight of the board. And then by both exchange rules, state laws, and SEC rules, the board is responsible for administering the overall equity program. That is almost always delegated down to the compensation committee or the relevant committee to manage on a day-to-day basis. But it is a requirement because of the dilutive nature of shares. It is required that it has oversight by the board, and that's not something they can just delegate fully to management to run on an annual basis. So there are a number of reasons why committees are very focused on this and making sure that they're not, as stewards to shareholders, that they're managing the dilution and the usage of shares appropriately within the organization.
Yeah, yeah, and that that dilutive cost, it's something that sometimes it's hard to wrap your mind around, but you really are giving away future value of the company. So making sure that you're managing that appropriately, particularly if you're a high growth company, that could be a pretty valuable asset of shareholders that you're using to motivate people. So you want to make sure you're using it appropriately. So
yeah, no question.
So I know there's a number of different ways. You mentioned run rate and dilution, a number of different ways that we can look at cost and the cost of these plans and the impact that they might have on a company. Maybe you can just kind of walk through what are some of those common approaches to measuring equity plan cost, and how should companies think about those different approaches?
Yeah, I think there's really two primary ones we'll start out, and these are the metrics that I'd say you'd start with as part of your analysis, is what you would use to benchmark against peers or against industry. It's also what investors and proxy advisors start with as part of their models. And the one is just straight run rate. So, and run rate, when we talk about run rate, it is what is the amount of shares you're granting typically on an annual basis, compared to the number of shares outstanding, so your common shares outstanding. So it is not what is ultimately earned for performance-based equity or stock options. It is the grant, the total grants made over a year as compared to that. And obviously, the more shares you grant, the higher that run rate is. Or, if you have a less common shares outstanding, that can also reduce the denominator and cause the number to go up. And as I mentioned, proxy advisors have their benchmarks for these by industry. It is very industry specific, depending on how deep in the organization you go with equity and other factors such as that. The second primary metric people look at is something called overhang. So it is what is the total dilutive nature of the plan. And that is both what is currently outstanding. So what are the awards that have been granted that have not been are not vested, or stock options that have not been exercised. So what are those sitting out there that just under normal course will continue to dilute shareholders on a go-forward basis, as well as what's the available amount of future value that's been approved by shareholders. So when you go out and get a equity pool, you request a certain percentage or a number of shares that you're going to have available to grant over a number of years within that pool. And how dilutive is that? So you kind of have your current overhang, which is what's been already granted, and then you have your available, which is what you still could grant in future years without having to go back for shareholders for additional requests. Together, that kind of makes up that total dilutive nature of the plan, the total overhang. So run rate, how much you're granting, overhang, how much is the total pool that you have approved by shareholders, could it be dilutive to the plan? So those are the primary metrics. The problem with those are they're both very based upon share price market cap, right? Your share price goes up, you can grant the same amount of value and your run rate's going to be much smaller. Vice versa, your share price goes down, which we see, in different industries over different times. Your same grant practices that you've been doing for years, all of a sudden your run rate goes up substantially because your share price is down. You need more shares to grant the same value to employees and to executives. So one of the things you can do that I think is an important check on the run rate is to look at your total grant value. And it's something you can benchmark fairly easily against your peers in the industry is what is that total value you're granting across the entire organization? So we, very typical to look on a per person basis when you do benchmarking for compensation levels. Well, how about on a total plan basis? So what did you grant over the year on a dollar basis? How does that compare to peers? How does that compare to your revenue? When we think about the size of an organization, market cap is obviously one of those, and that goes right into the run rate and share price. But how about from a profit perspective, or even just a top line revenue or assets in certain industries? How much are you granting on a percentage? And and many times, if your share price is depressed, your run rate may be above the benchmark or median or near the top of the peer group, but your actual grant value that you need to manage your business may be appropriate and may even be below other peers who are granting equity. And then just it's your share price that is really driving that run rate up. So I think there are the basic things you look at, but then there are that secondary level that you want to go into. And many times when activists, they like to look at run rate and share usage. It's one of the things that they tend to go after when they're looking for compensation elements, and they will look at it beyond just run rate. So they will look very much at what percentage of your profit are you granting in equity, or how much of your revenue you're granting in equity. So I think that second level benchmarking is an important insight to really interpreting the outcome of just looking at run rate and overhang.
Yep. Yep. And maybe just to clarify, we've been using the term run rate. Another term which is really interchangeable with run rate that often gets used is burn rate. But typically, whether somebody's talking about burn rate or run rate, they're talking about that same thing, that annual usage. And with dilution, another way to kind of just think about it, a simple way is it's, what portion of the pie are you giving away? If you think of the equity in the company that's owned by shareholders, you're basically saying we're going to take a sliver of that and we're going to use that to motivate, employees, executives, whatnot, to grow the firms. And is that fair? And, to your point, lower market cap means if you're going to deliver the same amount of value with a lower market cap, it's going to take a bigger piece of the pie, which it's very helpful to look at all of those things you looked at. You talked about, looking at it on a basis of revenue or profit or whatnot. But at the end of the day, you do have to kind of circle back to that piece of the pie, because if I'm an investor, that's what is impacting me. I'm seeing, and if I was an investor and I owned 10% of the company, let's say, and you dilute me by 10%, now I own 9.1% or something like that of the company. So is that worth it to me as an investor? Do I feel like this company is going to grow enough to make it worth me, feeling comfortable with that level of dilution? So, yeah. So maybe we can explore some of the avenues here of what can impact those costs. So, obviously, if a company is very aggressive and they're granting a lot of equity and they're maybe a 75th percentile payer from an equity pay perspective, that of course is going to drive higher run rate and dilution. But there's a lot of other factors that can impact run rate and dilution. So maybe you can kind of walk through what are some of those other factors that that can impact those numbers.
Yeah. So obviously, grant date value and share price are going to be the two biggest ones. But then there are probably two others that are primary drivers that you see, and they're very industry specific. So one would be, how deep in the organization do you grant equity, right? There are certain industries, let's think technology, who may grant much deeper into the organizations an expectation that all employees or a significant portion of employees are receiving equity awards on an annual basis. And that's going to obviously drive the amount of shares you use and therefore the run rate that gets required. But also the mix of equity. In the one way to think about it is stock options. Stock options tend to be the most dilutive from a run rate perspective, uh, because to grant the same value of equity, again, from a Black-Scholes and from an expense perspective, you need to grant multiple stock options to grant that same economic value that you would have in a full value share. So whether that's 3 to 1 or 5 to 1, so meaning you would grant, 3 options for every full value share to grant the same value, or 5. A lot of that depends on your Black-Scholes and volatility and a number of other factors. But using stock options and using those deep in the organization tend to be more dilutive. You're going to require more shares to grant to deliver that value than you would in a full value share. And then that's from a run rate perspective. In terms of actual dilution of what hits the market, you can have the same thing for performance-based equity, right? That if you have upside on shares and you ultimately earn above target on those performance-based equity grants, they ultimately could be dilutive on an actual basis. Generally we look at it more on a target on a grant date basis, but it is something to also monitor and say, well, what is the actual dilution occurring? What are we paying out performance shares above target or below target? Are stock options underwater, or the share price been, going up over time, and those options are extremely dilutive to shareholders because of the number and the embedded value in them.
Maybe let's talk a little bit about some other terminology, because the other term that we often hear here is the share reservation, and what's available in the plan. What's the difference between share reservation and what we've been talking about around dilution and run rate?
Yeah, so we've been talking really about that grant date value. So how much are you granting? What is that run rate or burn rate on an annual basis? And kind of what is that total dilution? That is what you're actually doing. The share reserve is what are you allowed to do? So what if shareholders approved? And for the majority of equity awards are under a shareholder plan. We can talk about some other ones that you can, for specific situations that may not be. But in general, your equity awards are going to be granted under your equity plan, which is a shareholder plan. And when you go out to shareholders as part of the proxy, you request a certain number of shares. That is your share reserve. That is how many shares you have available to grant before you would have to go back to shareholders to request more shares. When we think about run rate, it's very much 1 to 1, right? We grant one option, we grant one RSU, we grant one performance share. That's going to go into that run rate calculation. That's different than share reserve. And it really is different in two different ways. The main one we see is performance shares. Generally, when you reserve against your equity pool for performance shares, most companies, not all, but most, reserve against a maximum number that can be earned against that award. And the rationale there is that you don't want to get to the end of, let's say, a 3-year performance period and you reserved at something less than maximum target and you don't have enough shares to settle those awards, right? That's, a situation you don't want to be in. So most companies, when they're looking at how many shares they have available in the pool and when they have to go back to shareholders, are going to reserve at maximum for performance shares, and they're going to release those shares back into the pool based upon what is ultimately earned within the equity award. Same thing for forfeitures or type of recycling if you have it in your plan. If someone leaves an organization, those shares go back into the reserve. They're still considered part of the run rate because you've granted them. But from a reserve counting and how many shares you can grant, typically if you have a forfeiture, you're able to re-grant those shares to a new executive the next year, et cetera. And then you can get to some very technical aspects of plan reserves in terms of ratios and fungible ratios of how much you count a full value share for a stock option, which can change it. In essence, all those three things really just mean why the reserve that you have is not going to be identical to what's used from a run rate perspective on an annual basis. The reserve is going to be over multiple years, how much you have, and all those different ways of counting shares. Whereas a run rate's really, what are you doing this year? What did you grant on an annual basis, and how does that compare to whatever benchmark you're looking at, whether it's a proxy advisor benchmark, an institutional shareholder benchmark, or just peer group and industry.
Yep. Yep. So the share reserve is the official number of shares that we still have available that have been approved by shareholders that are available for grant. So what do companies do when they're starting to see that run low and they need to maybe stretch that share reserve a bit? What are some of the approaches to try to get the most out of the remaining reserve?
Yeah, no, I think it's a great question, and this is separate of actually going back for shares, which I know we can discuss a little bit afterwards. But if you're just looking at how to maximize your share pool, for whatever reason, maybe you just have low on that reserve, your share price is down, or for whatever reason you're trying to manage that share usage, run rate, etc. There are really a couple of different things to think about, and there's many more that we can talk about, but one would be just looking at the mix of equity. As we talked about, certain types of equity are more dilutive, specifically stock options. So if you're a heavy option user and you're granting significantly more options on a value basis than you would full value shares, you can look at that. And that could be just in general across the program, or that could be by level to say, well, are we really getting the value out of a stock option at a certain level in the organization, or would there be more value in granting a full value share or RSU that maybe is understood more, appreciated more, et cetera, and is less dilutive from a share usage perspective. So you can look at the mix of equity. Additionally, you can look at cash. Again, that's typically done on I don't want to say last resort basis, but it's lower on the list of priorities. Is should you be granting long-term cash instead of equity? And it's one of the items that you have to consider if that share reserve is low, you don't have enough shares. The other thing that many companies do, if it's really on a temporary basis, so maybe you have a low share reserve, you're expecting to go back for shareholders at a April shareholder meeting or May shareholder meeting, but you normally grant equity in Q1. Maybe it's February or March, but we don't have enough equity to grant to everyone under the normal practice this year. So you can do those things about changing your program, but you're not really looking to change your program. It's just a timing thing is what we're talking about. So at that point, there are strategies you can take from granting contingent upon a new share reserve, where from an end user perspective, it looks like they're getting a normal grant on the normal day. From an accounting legal perspective, you're waiting for that new share reserve to be approved. You can delay your grant. You can delay the grant or split the grant depending on the vehicle you're doing. Generally, this tends to get harder with stock options because stock options, the share price used for exercise price really is on the legal grant date. And not on an earlier date, or if you're doing performance-based equity, you may not want to delay the performance period or grant date till after the performance period. So there's considerations that you need to think about when doing any of those. But those are all strategies if you're kind of on that timing perspective. And then the last thing I'll mention that is used, in certain circumstances and actually certain industries more so, biotech, for example, pharma uses this more so, is the idea of a inducement plan or an inducement grant. So there's requirements that you need to do for that. And when I say inducement grant, it is really when you're bringing in an executive or an employee from the outside. So they're not a current employee being promoted or being granted, but you're hiring someone from the outside and you're granting them a new hire equity award. Under certain circumstances, you can make that under a inducement award, whether it's a single award or a plan that gets approved by the board. And that is, in essence, granted outside of the shareholder approved plan. So it still affects your run rate. When outsiders look at the number of shares that you've been granting, they're still going to include that. But let's say you're hiring a new CEO this year, it's going to require a large buyout, inducement award, et cetera, and you don't want to use up your entire or significant portion of your share pool. There is an ability to use something called an inducement grant, which would then take that outside of your shareholder approved plan, grant it under the inducement award plan, and still maintain the available shares within your plan under normal course. So there are, again, requirements around disclosure and approval and format that you have to do for those. But it is something that can be very useful, especially at the most senior level when you're hiring new executives.
Yep. Yep. One other scenario that I was thinking of that we sometimes see companies fall into, and it's a very difficult situation to find yourself, is just where you've had a significant decline in market cap. And maybe your market cap has fallen by half or even more than half, and so you're in this situation where not only are you running low on shares, but you're going to be at a very high level of run rate going forward. That's really unsustainable, and there's often a question: well, what do we do? One possibility, it's not ideal, but one approach I have seen companies use in that case is moving from a grant date value grant methodology to a fixed number of shares. So rather than saying, we're trying to grant this individual, let's say $10,000 worth of equity, and we're going to divide that 10,000 by stock price to get to the number of shares we grant, you just simply say this individual is getting X number of shares. They're getting 1,000 shares, and so the actual grant value might actually be less than you were ideally targeting, but at least it fixes the dilutive cost and the run rate to hopefully a more manageable level. So again, not an ideal scenario, and something that, if you have to do that over time, you're probably going to be paying people below competitive levels. But I have definitely seen companies have to fall into that scenario occasionally.
Yeah, no, I agree. And many times just tying it to the prior year share price on the data granted, you've had a significant reduction. But
Yeah. Yeah. So Dan, maybe one kind of final question, and this is a big question which we could spend a whole podcast just kind of walking through it, but maybe you can just give us a few highlights to think about, and that's how to navigate the process for getting additional shares from shareholders. So if you do run out of shares in that share reserve, of course, the way that you replenish that is you have to take that to a shareholder vote. A lot of things to think about to navigate that, but maybe you can just highlight a few of the key considerations there.
yeah, no, I think you could easily spend an entire podcast on this and the challenges or intricacies. But at a high level, when you think about the share reserve, most companies go back for shares in essence the year before they think they're going to be needed, because of that timing, right? The delay in that most companies grant equity in Q1 or early Q2, where shareholder meetings tend to be later in the summer or year, depending on your fiscal year, and therefore you need to get ahead of it. So it's one of the things you want to monitor to make sure that you're tracking not just the shares you have currently, but how much will you have after the next award to make sure you have enough to get ahead of the next grant. So typically you're going back you've made your grant, you don't have enough for the next year, so you go in that year in between that proxy and the shareholder vote, you go there. I'd say that generally most companies would like to stay within, the boundaries of market or many times the proxy advisors. They have models that they look at. They kind of look at a total overhang that we've talked about and how much value would a new plan be transferring to shareholders or to employees compared to shareholders. And if you can stay within those bounds, you generally are going to have a very successful outcome from a share pool request perspective. The days of requesting 5 years, 6 years plus of shares is really not the market that we see. Generally now we're in the kind of 1 to 3 year basis that you get enough shares for a year, 2 years, 3 years of awards, and you go back to shareholders. There's plenty of situations with large companies who may have to go back to shareholders every year or every other year to request shares. And that's not an issue. It's not something that is frowned upon or looked down upon. It's just part of, what do you have outstanding and what is, your model. So when you go through that, ideally you can go through that model, stay within the bounds of the investors and proxy advisors. You go through in these paths and you get your shares. There are situations, and usually it's in the situations that Ryan, that you were talking about, where share price is depressed, you've had a significant reduction, you've had to use significantly more shares for retention, hiring, or whatever it may be. And when you go through that model of looking at past run rate against the benchmarks or how many shares you have outstanding, you can't get sufficient shares to run your business under the way that you, as an executive team and board, want to under the proxy advisor models. So then the question is, what do you do about that? And generally, you you can look at more of a, well, what is required, a bottom up approach. So what do we need on an annual basis? How much at different share prices? What would get us 1 year, 2 years, 3 years worth of shares, all staying within reason, knowing that you're not going to pass the proxy advisors. So the impact of that is generally, you know, ISS and other proxy advisors generally vote against 25, 30% of plans on a given year. It has an impact of, let's say, 25%, give or take, impact on the vote. Unlike, say, on pay, where there's certain thresholds that if you're below 80% or 70%, there's a expectation of responsiveness. New share requests, really, you need 50% plus one vote. It is not something that impacts say on pay. It's not something that gets carried forward to future years. It's an understanding that most investors understand you need equity to run your organization, to reward your executives, and therefore, as long as you're asking for a reasonable amount, it probably requires shareholder outreach and having those conversations. But these still pass 99% of the time. So as long as you're not going out and asking for something outrageous, and you're having the conversations with your biggest shareholders ahead of the shareholder meeting, and so even if you don't pass the quote quote proxy advisor test that may limit the amount that you have, these plans nearly always pass and receive above 50% support from shareholders.
Yeah. Yeah. No, excellent point. I mean, we see many companies spend a lot of time and energy and sometimes anxiety about what the right request is. But as you said, these requests almost always pass. I mean, you could look over the last 10 years and very few have ever failed, and it's usually some kind of very extreme cases where they do fail and get less than that 50% threshold. So Dan, thanks again for coming on the podcast today. I think this has really been a helpful and interesting conversation.
Of course. Thank you for having me, Ryan. I appreciate it.